Good morning and welcome to the June 2026 meeting of the SEC's Investor Advisory Committee. I'm George Georgiev, a professor of corporate and securities law at the University of Miami School of Law, and I serve as the chair of the committee. As a first order of business, I would like to welcome 4 new committee members who were appointed earlier this week. Patrick Doherty, a partner at the law firm of Foley and Lardner. John Liu, a senior citizen investor and former managing director at Accenture, who will serve as the representative of the interests of senior citizens. Sheldon Ray, a professional portfolio manager. And Adriana Robertson, a professor of law at the University of Chicago School of Law. Welcome. We're all very excited to have you on the committee, and we look forward to working with you. I would also like to recognize again the 8 IAC members whose term expired at the end of last month, as well as Nancy Lamond of AARP, who for a number of years served as a representative of the interests of senior citizens on the committee and recently stepped down. At this point, I will turn over the mic over to Mark Sharma, who will conduct a roll call.
Good morning, everyone, and welcome. I will conduct the roll call in alphabetical order by surname. So we'll start with Rodney Comegis.
Present.
James Copeland.
Present.
Patrick Doherty.
Present.
George Georgiev.
Present.
John Gulliver.
Present.
Craig Kanoki.
Present.
Craig Kanoki is joining remotely. John Liu.
Yes, thank you.
Present.
Amy McGarity.
Present.
Sheldon Ray.
Present.
Adriana Robertson.
Present.
Sergio Rodriguera.
Present.
Andrea Sight.
Here.
Andrea's site is joining remotely as well. Alvin Velasquez.
Good morning.
Thank you all. Back to you, George.
Apologies for the audio difficulties. We'll begin with opening remarks from Commissioners Hester Peirce and Mark Ueda. We'll also hear from Chairman Paul Atkins later in the afternoon. Today's meeting will feature 2 expert panels and 2 committee recommendations. Our morning panel is titled Avoiding Retail Confusion Regarding Private Market Assets, and will be moderated by 2 members of the committee, Amy McGarity and Andrea Sight. Amy, to my left, is the Chief Investment Officer and Chief Operating Officer of the Colorado Public Employees Retirement Association and serves as the Secretary of the IAC. Andrea is the Ohio Securities Commissioner and serves as the Vice Chair of the committee. The panel will discuss the potential for investor confusion arising from redemption gating, fee structures, valuation methodologies, and other unique features of private markets and alternative investment products. This panel continues the IAC's focus on the investor protection implications of retail access to private market assets. The panel brings together a diverse set of perspectives and will examine how risks are disclosed to retail investors in offering and marketing materials and how product advertising is reviewed by regulators. It will also explore strategies that both the securities industry and securities regulators could implement to avoid investor confusion and hardship. Our afternoon session will begin at 1:45 p.m. with a panel titled Passive Index Funds and Shareholder Voting. The panel will be moderated by Jim Copeland, who is a member of the IAC and the Senior Fellow and Director of Legal Policy at the Manhattan Institute. The panel will discuss the potential risks and benefits associated with passive index funds' exercise of shareholder voting authority, including concerns related to managerial accountability, fiduciary obligations, shareholder activism, and the influence of large asset managers. The panel will also examine current proposals such as pass-through voting, voting choice, mechanisms such as mirror voting, as well as practical and regulatory challenges associated with implementing such models. It will also explore strategies that fund managers, market participants, and regulators could adopt to better align voting practices with investor preferences and the governance objectives of passive investment products. We will then consider and vote on 2 draft recommendations. The first recommendation is regarding fund proxy voting, and it follows from a panel we did in March. It pertains to the modernization of the fund proxy system for open-end funds and ETFs. This recommendation will be presented by Rodney Comegis, Global Head of Global Head of the Equity Investment Group at Vanguard, and he also serves as the Vice Chair of the IAC's Investor as Purchaser Subcommittee. The second recommendation focuses on semi-annual reporting versus quarterly reporting mandates, and it also follows from a panel we did back in March. It will be presented by John Gulliver, Executive Director of the Committee on Capital Markets Regulation and the Program on International Financial Systems. He also serves as Assistant Secretary of the Investor Advisory Committee. And without further ado, I'll turn it over to Commissioners Peirce and Ueda for opening remarks. And thank you for being here.
Thank you, George, and there was not much ado about the fact that you're the new chairman, and so thank you for taking that task on, and thank you to the rest of the leadership committee as well. I appreciate it. As you already know, it's a thankless task with a lot of responsibility, so appreciate you doing that. And I want to thank the members of the IAC who stepped down, and I want to welcome the new members of the committee. We selected you as members because we believe that you have something uniquely helpful to offer to the conversation. With its diverse experiences and perspectives, this committee can be a valuable advisor to the Commission. Active participation by all members maximizes the committee's effectiveness. You do not need to be an expert in the matter under discussion to ask questions of the panelists or to raise points. Often a fresh look at an issue from someone who has not been steeped in it can help clarify the problem or identify a solution. Today's first panel, as you've heard, is a continuation of the IAC's work on retail investor access to private market assets. It's an important topic, and the panel will discuss specifically the potential for retail confusion, as you heard, around redemption gating, fee structures, and valuation methods and strategies that the securities industry and regulators could implement to avoid investor confusion. I do have several questions for that, for your consideration during that discussion. First one is, doesn't the existence of features of these funds, such as gates and incentive fee structures, help focus investors on the illiquid nature of the fund's portfolios and the need for investors to consider whether the fund is compatible with their own liquidity needs? Second, would requiring registered funds to include additional disclosures increase the likelihood that fund investors already overwhelmed by the disclosures they receive simply ignore all fund disclosures? And third, is improved investor education the best path to address concerns about investor confusion? The second panel, as you heard, will revisit the topic of voting by passive index funds. I pose the following questions for discussion there. As I noted at the committee's June 5, 2025 meeting, the right to vote belongs to the fund itself, not to the fund's advisor or to its investors as shareholders. A fund's board may delegate voting power to its advisor, but the advisor must exercise it in the interests of the fund alone. Can a pass-through voting policy be compatible with an advisor's fiduciary duty to the fund? Second, would pass-through voting serve only the interests of the subset of fund investors that choose to express their preferences, which may be inconsistent with the fund's best interest? Third, how could mirror voting, where the fund votes its shares in the same proportion as the other shares in the company are voted, so that means the fund would be voting some for, some against a proposal, would that serve the interests of the fund? I also have some questions to contribute to what I hope will be a vibrant discussion of both draft recommendations under consideration today. New members, you should feel free to participate in the discussions about those recommendations and in the votes. And I remind seasoned members of the value in sharing at this public meeting the discussions that you've had behind closed doors or over email between the meetings as you've crafted those draft recommendations. Having access to all members' views and thoughts that shaped your vote greatly enhances the value of this committee and its work. And so I really urge you to share those thoughts with me. I appreciate the draft recommendations regarding fund proxy voting, which give us some really concrete things to think about, so I'm grateful for those. The draft follows the committee's excellent discussions on the matter at a prior meeting. So my questions are, would permitting fund opt-in retail voting programs similar to the approach outlined for ExxonMobil in that no action letter, would that sufficiently address funds' ability to achieve quorum, or would the commission need to do more? Second, do you share my concern that the medium-term action recommendations would deprive shareholders of their voting rights in certain consequential matters, such as certain changes in fundamental policies. Third, the first long-term recommendation would allow funds held through intermediaries to communicate directly with their shareholders on proxy voting matters. During the discussion at the prior meeting, we heard about the anger of shareholders at being contacted. Would this change anger and confuse investors? Would objecting beneficial owners be covered? And would this recommendation significantly reduce costs and improve voter participation? I also look forward to the committee's discussion of its draft recommendation on our semi-annual reporting proposal, which mirrors concerns that we've heard from commenters in the first half of the comment period. As part of that discussion, please consider the following questions. The draft recommendations suggest that one of the main justifications for the proposal was combating short-termism, but the proposal really only briefly raised that point and declined to put much weight on it. And I'm just reading here from the proposal. There's some evidence that decreasing reporting frequency could reduce short-termism. Overall, however, the effects of reporting frequency on real corporate decisions are mixed. So in speaking recently with companies, particularly small ones, I've heard a different rationale, not short-termism, but the fact that the cost of the Form 10Q does not yield proportionate benefits for investors. To answer this concern, should we streamline the reporting burden rather than adjusting whether that burden happens quarterly or not? Second, if so, is that exercise better undertaken in conjunction with a specific rulemaking or as part of the Commission's broader project of assessing disclosure requirements? Third, even if we were not to make quarterly reporting optional for all companies, should we make it optional for smaller companies? And fourth, I really appreciate that the committee is providing feedback on a current Commission initiative. In that vein, I recommend for your future consideration two important, albeit pretty technical, proposals related to filer status determination and the registered offering process. These proposals are part of the Commission's effort to encourage companies to go and stay public. Do you have other suggestions about how the Commission can achieve this important pillar of our agenda? Thank you again for your willingness to dedicate so much of your time to the IAC. Thank you also to Mark Sharma, Adam Moore, and Charles Kwan for their work with the committee, particularly in making sure that our new members could join us today. Thank you.
All right, well, good morning, everyone, and welcome to all of the committee members, especially the four newly appointed ones. So John, Adriana, Patrick, and Sheldon, welcome. Thank you very much for agreeing to serve as members of the committee and for your commitment to public service. And just to show how committed our members are, I know Craig is participating virtually from Tokyo, where I think it is about 11:20, 11:25 right now in the PM over there. So Craig, I hope you are perhaps in an appropriate izakaya with a beverage of your choice while you sit through this. So thank you for that, and thank you, Commissioner Seid, for participating virtually. I'm assuming you're in Columbus today, but let me know otherwise. I know I'm sitting next to my right another very, very proud Ohioan, so thank you for that. I'd also like to congratulate George on your new role as chair. Good luck. It is, as I think Commissioner Peirce said, a lot of work, and I really do appreciate your willingness to lead the committee, and we're all very excited to see you in this role in the year ahead. So today's first panel will discuss potential investor confusion on certain features of private markets and alternative investment products, such as with respect to redemption gating, fee structures, valuation methodologies. While market events over the past several months have made this topic quite relevant, and in fact, I was just earlier this week at a meeting with counterparts at the Financial Stability Board, and this topic was very much at front of their mind. The general question of whether investors understand the specific features and risks associated with a particular financial product is nothing new. This has been a problem we've had throughout the history, I think, of the federal securities laws. Do investors know exactly what they are getting? what they are signing up for. And in some ways, I think one of the issues we face today, the answer has always been, well, let's just add more disclosure and more disclosure and more disclosure. And then we'll have a summary on top of that. Now, recently, certain private credit funds faced elevated redemption requests, which prompted fund managers to implement limits on redemption. The redemption gates were not, at least in my view, per se evidence of product failures. Rather, the gates worked exactly as they were intended and disclosed, thereby aligning the fund's redemption structure with the less liquid nature of the underlying portfolio securities, preventing the fire sale of assets, and ensuring that all investors, particularly the remaining shareholders, are treated fairly. These limitations are intentional features. But a significant number of investors appear to have been surprised or confused by the redemption caps, which suggest a mismatch, potentially, between investor expectations and the prospectus disclosures for that product. This suggests potential sales practice concerns that, in many ways, are already covered by existing SEC and FINRA rules. But I've been told that perhaps our rulebook is not quite thick enough to cover these things, so I guess there's always room for more. The second panel will address the corporate governance and investor protection implications of the growing concentration of voting power in passive investment vehicles. In his book, The Problem of 12, former SEC General Counsel John Coates makes the observation that the rise of passive index funds has led to an unprecedented concentration of voting power. The four largest index fund providers collectively control more than 20% of the votes of the S&P 500 companies. And as he frames it, this means in practical terms, a small number of individuals, perhaps as few as a dozen, exercise an outsized amount of proxy votes over many of the public companies out there today. And the more such asset managers exercise influence on a board's composition, executive compensation, risk management, other proxy or shareholder proposals, without obtaining some form of direction or mandate from fund investors, the more it starts to resemble active control. And this phenomenon raises important questions and concerns regarding fiduciary obligations, the impact of corporate governance, and the level of transparency between the communications from these large shareholders to corporate boards and corporate management. How proxy votes held by funds are exercised also has broader implications, such as regarding Schedule 13D and 13G reporting, as well as the regulation of proxy advisory firms. The panels today will discuss various proposals, such as pass-through voting and mirror voting, and explore the practical and regulatory complexities of each of these approaches. And later this afternoon, the committee will consider recommendations on modernizing the fund proxy system for open-end funds and ETFs, as well as quarterly and semi-annual corporate reporting. I appreciate the work that the committee has put into developing these recommendations. The Commission welcomes input on these topics, and having a range of perspectives is what this committee is intended to provide. So thank you again to the committee members and the panelists for your time in preparing this meeting. I look forward to the discussions, or at least the readouts. I apologize if I won't be here the entire day, but I certainly have my staff looking at what transpires. So thank you very much. Over to you, George.
Thank you, Commissioner Peirce and Commissioner Ueda. At this point, I would like to turn our attention to the minutes from our most recent meeting, the March 2026 meeting, and I would like to have those minutes reviewed and approved. Do we have a motion to approve the minutes?
Motion to approve.
All in favor?
Aye.
Aye. Anyone opposed? Anyone opposed? All right, the minutes are approved. With that, I will turn it over to Amy McGarity and Andrea Seit for our first panel of the day, Avoiding Retail Investor Confusion in Private Markets. I think Andrea will go first. Yeah.
Yes, I will go first. Thank you, George. Thank you to the chair. Last year in September, the IAC issued a pretty weighty package of recommendations to the SEC in response to what it perceived as the mainstreaming of private market assets to retail investors. Then, as will be the case today, the committee would sometimes refer to those private market assets as alternative assets or alternative products. The IAC recognized that expanded retail access was something that certain SEC commissioners and staff were interested in, some vocally supportive. So the committee has given some thought to how the SEC could meaningfully expand investor access without sacrificing investor protection. The IAC concluded back in September that the safest, most prudent course would be for the SEC to expand retail access indirectly by relaxing some of the requirements imposed on registered funds that hold private market assets. The IAC gravitated to registered offerings because those products already include several retail-friendly safeguards, things like commission review, audited financials, professional fund management, diversification, greater liquidity, and the protections of the 40 Act. Importantly, the IAC did not take a position pro or con on whether the SEC should go further and take action to affirmatively expand retail access directly by, for example, reforming the accredited investor definition or relaxing other restrictions governing access to exempt and unregistered offerings. The committee recognized, however, that direct expansions may materialize nonetheless, given the number of SEC proposals and congressional bills that we've seen floated in recent years that seek to achieve that very purpose. For that reason, as a fail-safe, we recommended that the SEC implement a set of investor protection guardrails if and when direct retail access becomes the law of the land or simply a new market norm. Today, we're going to continue that dialogue with the understanding that, for better or worse, retail investors are being increasingly exposed to private market assets. This is true for direct and indirect retail access through registered and unregistered products in taxable and in retirement accounts. Many private market or alt asset offerings are complex, illiquid, riskier, and generally more expensive than traditional asset classes. So the committee is examining what regulators and industry leaders are doing or should do to ensure retail investors understand and can tolerate the risk associated with these products before they invest, especially with their retirement savings. So at this point, I'd like to turn the mic over to my colleague, Amy McGarity, who will moderate the panel and get things started by introducing our panelists. So thank you.
Thank you, Andrea, and thanks for our panelists for being here today. I'm going to provide a brief introduction. Just to caveat all of my moderation skills, so to speak, Andrea put this panel together, and I'm really grateful for her support and knowledge on this topic and guidance throughout this whole process. So with that, we have an excellent panel of experts joining us today, both in person and one online virtually, to share their insights into the sale and marketing of private market assets to retail investors. Jason Zweig, the first of our panelists, writes the Intelligent Investor column and newsletter for the Wall Street Journal. Jason has often discussed the mainstreaming of private market assets in his columns. He is also the author of Your Money and Your Brain, On the Neuroscience of Investing, and the editor of Benjamin Graham's The Intelligent Investor. Before joining the Journal, Jason helped the Nobel Prize-winning psychologist Daniel Kahneman write the book Thinking, Fast and Slow. Earlier, Jason was a senior writer for Money Magazine and a senior editor at Forbes magazine. A graduate of Columbia University, he also studied Middle Eastern history and culture at the Hebrew University in Jerusalem. Stephen Dean is joining us virtually. He is the Senior Director for Capital Markets Policy at the CFA Institute in Washington, D.C. He previously worked right here at the SEC Office of the Investor Advocate, where he served as staff liaison to this committee. Stephen has testified before Congress and has written and spoken on the topic of private markets at industry conferences and to securities regulators in the U.S., Canada, and Australia. Stephen has been working for more than a year on a series of reports focused on ethics in private markets. His previous reports include Continuation Funds, Ethics in Private Markets, and Private Markets Governance Issues Rise to the Fore. And his articles have appeared in Barron's, Institutional Investor, and elsewhere. Stephen began his career as a newspaper reporter and worked in international economic development. Stephen earned a BA from St. John's College and a master's in Russian studies from Harvard University. He holds a CFA charter and a private equity certificate from Wharton Online and Wall Street Prep. Joseph Shearer is here with us in person. Joe is a Senior Vice President of Corporate Financing and Advertising Regulation at FINRA, the department responsible for reviewing advertising for products sold by broker-dealer firms here in the U.S. FINRA has promulgated rules and issued guidance relevant to the products that will be discussed today. Prior to his current role, Joe led FINRA's National Member Supervision Firm Examination Program, oversaw multiple district offices, developed and oversaw FINRA's National Membership Application Program Group, and worked in varying capacities in a number of other FINRA departments, including risk and oversight and operational regulation, continuing education, testing, and qualifications and registration. Mr. Shearer is a graduate of Brooklyn Law School and Drew University and is a member of the bars of the states of New York and New Jersey. Mark Higgins is a financial historian and author whose work seeks to apply the lessons of financial history to inform investment decision-making in the present. The foundation of his work is his book, Investing in U.S. Financial History, Understanding the Past to Forecast the Future, which recounts major economic and financial events that shaped the history of the United States from 1790 to 2023. Mark is a member of the editorial board of the Museum of American Finance, guest curator for the museum's forthcoming physical location opening on July 1st, 2026 in Boston, Massachusetts, and is a frequent writer for the museum's Financial History magazine. In May of 2026, the CFA Institute Research and Policy Center recognized Mark as a voice of influence, and he frequently contributes articles to the CFA Institute's Enterprising Investor. Mark received his undergraduate degree from Georgetown University and earned his MBA from the Darden School of Business at the University of Virginia. And our last panelist in person here is Kevin Gannon. He is the chairman and CEO of Robert Stanger & Co., Inc., and has been the lead investment banker on more than $100 billion of merger and acquisition assignments involving alternative investment securities. Mr. Gannon is a frequent speaker at industry events sponsored by IPA and ADISA and is frequently quoted in the Wall Street Journal, Bloomberg, Reuters, Altwire, and Investment News. His firm is a leading source for data on all alternative investments, including non-traded REITs and business development companies, interval funds, tender offer funds, Delaware statutory trusts, and other private investment vehicles, many of which I had to look up to find out what they were. Thank you again to each of our panelists for joining us today. So with that, let me just take you through a bit of a run of show. I have an opening round of questions for each of our panelists in order to really identify some speaking topics that they'd like to discuss. Then I'll follow it up with some general questions, and then I'll open it up to the committee members at the end for the last 30 to 45 minutes for questions. So a question for Jason. We are going to start the panel discussion today with you. You have written extensively about mainstreaming of alternatives or private market assets in your column and the newsletter, The Intelligent Investor. You have been a little skeptical about this trend, having referred to it as Wall Street's big, bad idea for your 401k, and have warned your readers that when Wall Street invites them to a private party, they should politely decline and say they're busy. I realize these headlines are written a little tongue-in-cheek, but the columns examine a fair number of real downside risks for retail investors. Why are you circumspect about retail investing in private market assets? What are the biggest downside risks that you see or areas that might be confusing to the average retail investor when considering private market assets?
Great. Thanks, Amy, and thanks to the IAC and the SEC for having us all here today. So I think the first point I would like to make from my perch at the Wall Street Journal, where I hear from thousands of individual investors every year, is that individual investors are not institutional investors who have less money. They're fundamentally, profoundly different. And they differ from institutional investors not as a matter of degree, but as a matter of kind. I mean, if we think about it, institutional investors have access to vast quantities of capital. They have extremely long, often perpetual time horizons. They benefit from having multiple sources of income, and they have access to deep professional expertise and experience on valuing alternative investments. Individuals, on the other hand, are prone to income shocks and spending spikes. They have finite investing horizons, not because they're more impatient than institutions, but because they're mortal. They have known spending needs, and they will have to draw down capital at specific dates in the future, and they have those income shocks and spending spikes. They're generally reliant not on multiple sources of income, but on either wage income or investment income or retirement income. And finally, although they presumably have access to a financial advisor, not all of those advisors are experienced, expert, or unconflicted. And in one of my columns, I drew the conclusion that if you want to invest like Yale, you need to be like Yale. And not many individual investors are like Yale, and I would also point out that it's not even clear that Yale is like Yale anymore. But no amount of marketing, no innovations in fund structure, and frankly, no regulatory action or reform is going to turn an individual investor who is not like Yale into Yale. And I have 4 fundamental concerns about alternative assets, which are certainly not unique to me. I mean, the first, of course, is fees. The second is liquidity. The third is valuation. And the most complicated one is conflicts of interest. I think regulators and many market participants, including individual investors, are accustomed to thinking of conflicts of interest as being potential events. But in the world of alternative assets, conflicts aren't potential events. They're a pervasive ecosystem. They are ineradicable. They are constantly present. They're often extraordinarily opaque and difficult to untangle. And it's easy to foresee a situation in which a 401k at a company owned by a private equity firm adds a target date fund to its 401k menu that is designed by a collective investment trust firm that is owned by a private equity firm. And the individual is advised by a financial advisor whose RIA is owned by a private equity firm, and expecting an ecosystem that complicated and that self-interested at so many levels to arrive at recommendations that are in the best interest of the 401k participant, in my mind, is an enormous challenge. So, I mean, to me, that's the big picture.
Great. Thank you, Jason. Stephen, our panelist who's online, you have also expressed some reservations about the mainstreaming of alts and private assets in your writings. In January of this year, you wrote an opinion piece called Retail Access to Private Markets. Continuation funds show why caution is critical in an institutional investor. You specifically called out liquidity risks and conflicts of interest as 2 major risks that create some challenges with continuation funds. What are you seeing, and what is the broader lesson that regulators and the industry should learn from that experience?
Yeah, well, thank you, Amy, and thanks for having me here. It feels great to be back to the IAC, albeit remotely. I'm not as far away as Tokyo, but I am in St. Gallen's, Switzerland at the moment. So I'm not at the SEC anymore, so I don't have to start with a standard disclaimer, but I do want to say nonetheless at the beginning at CFA Institute, We strive to be non-biased and objective. Our members are individuals, they're not firms, and they include both the managers of some private fund sponsors, but also we have people who work for institutional investors who are the investors in those funds. So we have people on both sides. I think Jason did a great job of just now spelling out some of the differences between institutional investors and retail investors. Now, in talking about continuation funds, I should say they've emerged from the traditional world of institutional investors, not retail investors. But nonetheless, I would suggest there are some lessons that we should at least look at as regulators contemplate expanding retail access to private funds. But let me just start with a little bit of level setting. What are continuation funds? How do they work? So very concisely, consider, say, a private equity fund. It's got a portfolio of assets. It's got a manager, a professional manager. And this manager decides it wants to take just one asset or maybe just a few assets out of the portfolio of that fund and put it into a brand new fund that same manager will create. And the manager will then continue to manage the old fund and the new fund. Well, that new fund is called a continuation fund or a continuation vehicle, or I'll say CV for short. The new fund will buy that asset or those assets from the old fund in something we call a CV transaction. The new fund attracts new investors, but the old investors, the investors in the old fund then have a choice. They can sell their interest in those assets, or they can roll those interests over into the new fund. And in practice, about 80 to 90% of those institutional investors cash out. So why would a continuation fund manager want to do this? Why would they want to set up a continuation fund? Well, first of all, they may feel they need more time or more money to develop the assets that they're going to transfer. Secondly, this is a really important liquidity event. This gets to one of the things that we've already started to touch on, liquidity. The institutional investors, some of them cash out. A lot of them, they need that liquidity. Why? Private markets have been suffering from a drought of traditional exits where the fund will sell or dispose of its assets traditionally in an M&A transaction or an IPO, when the manager can take those proceeds and distribute that money back to the institutional investors. But we've got a drought of that. Bain Capital estimates that at the end of 2025, so quite recently, global private equity buyout funds have portfolios in aggregate of 32,000 unsold portfolio companies. And they're worth an estimated $3.8 trillion, and that's trillion with a T. That's called an exit overhang. And as Bain says, those numbers are staggering. So without the proceeds from a drought, because of the exit overhang, the investors, again, are not getting the distributions they had originally expected. So they're feeling an acute need for liquidity, and it's that need for liquidity that is driving the growth of continuation funds. Well, it raises the question, is this a temporary market dislocation, or is it a sign of a deeper malaise? I think we do not know the answer to that yet, but I also think it raises a number of questions for retail investors. First, if we just think of what Jason said of the differences between retail and institutional, how are retail investors going to cope with illiquidity when the institutional investors who are set up and can deal with this, they themselves are struggling? Second, if retail investors enter private markets en masse, are they going to be entering just as these market conditions prevail with this exit overhang? Are retail investors aware of that exit overhang and illiquidity? Are regulators aware of it? Thirdly, I think it raises the question or the risk of adverse selection. Now, if retail investors come in en masse, they could supply the missing liquidity, the liquidity that a market needs and doesn't have. But what's going to happen? Does that mean that the funds that exist now are going to sell otherwise unsold, unwanted assets to unsuspecting retail investors? So that's it at this point on the liquidity piece. Let me get to the other part of what you asked, the conflicts of interest, which Jason also mentioned. With continuation funds, conflicts of interest are inherent because the manager, the general partner, sits on both sides of the CV transaction. To determine the CV transaction price, the manager does or should set up and conduct a bidding process with third-party investors. It selects a winning bidder, so that's the lead investor. It then negotiates with that lead investor on the terms and on the transaction price. But there's still a conflict because the general partner, the manager, is both conducting this process but has strong financial interest. I thought this was really captured in a headline of a Matt Levine column that read, "Buy low, sell to yourself." But it's not just price. There are a lot of other strong financial incentives that the general partner or manager has. The continuation vehicle allows the manager to prolong the management fees, to reset the financial terms, to crystallize the carried interest or performance fee on the CV transaction. And they can reset their carry option in the new fund. So and I think that's especially valuable. The carry option, that's their performance fee that they get only if the fund performs. But imagine, so anytime you can reset an option, it's valuable. But imagine that the old fund is mediocre. It's not doing so well. Maybe the manager is concerned it's not going to be profitable enough to overcome the stipulated hurdle rate. And so the manager is not going to get that carried interest. It's not going to earn his performance fee. Well, now they can go to the new vehicle and reset their carried option. So that's really important. Now, having said all that on the conflicts, I need to say also, there are mechanisms that the market has evolved to deal with, to address these conflicts. There are processes to deal with them. They're imperfect. I think they can and do work often. They supply market discipline, but they are predicated on an investor base of institutional investors. I have doubts that they would work with an investor base of retail investors. Now, I'm not going to go into details. I think I've talked long enough at this point, but I hope I've given you a flavor of why we should maybe look at continuation vehicles as we consider retail investors. Thank you.
Thanks, Stephen. I wrote down buy low, sell to yourself. So thanks to you and Matt Levine for that one. Mark, you are a financial historian and recently have been writing about the cracks that are emerging in the private markets, drawing parallels to earlier crises in our nation's history. What are you seeing, and how concerned should we and the country's key market regulator, the SEC, be?
Thank you, Amy, and thank you to the SEC and the IAC for having me. My perspective on these funds is heavily shaped by history, but I'm also an investment advisor by day, so there's a practical element to this. But most of it is history, and after spending 3.5 years just immersed and gradually reading myself from 1790 to the present, several patterns emerge that you just don't see in your own lifetime, mostly because they don't repeat that often, so they often get overlooked. And one of the patterns that I become especially sensitive to when it reappears, because it has reappeared a few times, is when you have a new financial structure that combines illiquid, long-duration assets that can't be sold quickly for the marked price, an implicit or explicit promise to provide periodic liquidity that is shorter than the duration of the assets, and the absence of a lender of last resort like a central bank or the Federal Reserve to step in if there's a crisis. We saw this in the mid-1800s with lightly regulated state-chartered banks. We saw it in the early 1900s with the trust companies, which eventually led to the Federal Reserve. And I think we're seeing it now in the 2020s with semi-liquid private market funds. And historically, what is worthy of paying attention to with these types of funds is the main risk stays hidden until it suddenly appears. And that risk appears to have manifested already with semi-liquid private markets funds today. And there are a few reasons why it's particularly concerning. One, as Jason referenced, these funds didn't come out of nowhere. I've written pretty extensively about the history of alternative asset classes and private markets, which is a big subset. And you've seen a wave of institutional investment that has kind of plateaued out in the past couple of years, over the past 2 decades. And there's a lot of evidence, as Stephen mentioned, that there's a big oversupply of capital right now, and much more scarce opportunities. Second, we're going to talk about this later, the valuation practices, particularly with private equity, that are allowed but not required under FASB's ASC 820 guidelines, essentially gives these funds the ability to buy private equity interests on the secondary market, immediately mark them up if they buy them at a discount, immediately mark them, which they often do, immediately mark them up to the NAV and report a one-day gain. And this can, the risk here is it could substantially inflate reported returns from the inception of the fund when the optics are especially important for fundraising. And then thirdly, investors may fundamentally misunderstand liquidity. And I understand that the gates are disclosed. It is, depending on how the salespeople represent it, but the gates are disclosed. But what is not clearly disclosed, in my opinion, is the context in which those gates are most likely to be relevant. And with vehicles like this, they are vulnerable to runs. When confidence in the entire asset class evaporates, the incentive shifts from individual decision of whether the person wants their money back to is the person, is another person going to demand it before me and I'm not going to get it back. And that is the historical danger of these types of funds, is they are vulnerable to runs that are very difficult to stop once they start. So I certainly concede that only time is going to determine the relative severity of these risks, but as everybody knows and was mentioned earlier, there are already some pretty clear manifestations that this may be happening as we speak. There was another announcement this morning. There were 2 more earlier this week. It appears to have spread from private credit to private equity, so there's some pretty clear warning signs here. As you mentioned, Amy, over the past year, I've written about these issues. It may not seem like it at times, but my goal is absolutely not to incite panic. It's not to create fear that's disproportionate to the risk. In fact, after studying this nation's history, and you can see this in my writing, I have developed a very deep respect for the resilience, the absolutely vital necessity, and relative to the rest of the world, the integrity of this country's capital markets, and it's not something I take lightly. But I also believe that history provides lessons, and when it appears that maybe those lessons have been forgotten or not broadly appreciated, there's a responsibility to speak publicly and honestly and make sure people are aware of those. And that's what I'm here to do today, and I hope it's not my role to govern policy, but I hope the perspective that I offer from history may help the IAC and the SEC create some good guidelines if they're determined they're necessary. Thank you.
Great. Thank you, Mark. That was super helpful. Kevin, we just heard from Jason, Stephen, and Mark. They discussed some of the risks or concerns that arise when retail investors are investing in private market assets. But the reality is, this market would not have grown this large, this fast, without retail investor demand. Why are retail investors clamoring to get into Wall Street's private party? When they arrive, what are firms doing to educate these investors on the downside risks that we've discussed so far? Where are there areas for improvement?
Great. Jackie, can you pull up that slide, please? You probably can't see it, but we'll make this deck 100% available to you. But what it shows you is that fundraising, what's gone on here the last couple of years and all the money that flooded into the space. And what we've seen here is the space has now got a run rate on what we track, non-traded REIT, BDCs, interval funds, tender offer funds, Delaware statutory trusts, and private placements of all the above. That run rate's was last year was about $200 billion to retail investors, $200 billion. 5 years earlier, it was $100 billion. If you look back on the last 25 years, it was an aggregate of $1 trillion. Okay, so the next $1 trillion we think is the next 5 years. So that's the steepness of the fundraising that's gone on in the space. What attracted people? Pretty simple, dividends. The distribution rate is what attracts people. When the NAV REITs took off, everybody remembers Blackstone came in. When that took off, their yield was like 5.5. Was 5.5. CDs were 25 basis points. High yield stuff, right? That attracted the capital. Everybody came in, let's go. Interest rates came down, so values of real estate went up. So total returns from real estate were 15, 20% per annum. That attracts people, right? That's easy to see why they're attracted, and everybody feels good about it. As rates rose, the opposite thing happened, and what we're fearful of is the runaway redemption queue comes at us, right? And all of a sudden that took off. Well, in the last 5 years, the redemptions in non-traded REITs and BDCs, I'll talk about them more in a minute, not $80 billion. $80 billion of redemptions. So the market, the semi-liquid product that we don't like the name, or we think it's maybe too simple or not explained well enough, it worked, you know? And the redemptions in the NAV REIT world caught up, right? They caught up with everybody. There's one guy that gated. We're very careful about the words we use. When you hit the cap, that's that 5% quarterly cap. That's the cap. It's contractual. Everybody agreed to it. It's fine. It's disclosed. Everybody knew about it. If you gate, you drop a gate before you hit the cap, that's bad, right? We don't like that. So we've only had one guy really do that in the NAV REIT world. We haven't seen anybody do it in the BDC world, and the numbers are cranking up, and they're cranking up for odd reasons. The press has gone all in on blowing up credit, even though these deals themselves haven't shown any losses per se. Other deals have, and they're fearful that those software loans and those other loans are going to go bad, and so people are redeeming. But they can redeem. 10 years ago, we didn't have that option. We were just stuck in this deal until hell froze over, and then they told us what it was worth. Now we can get out with caps, 5%, 20% a year can get out. And these guys have honored that. They've gone to great lengths to honor that, using liquidity sleeves set up at the beginning of the deal, and the liquidation of assets and financings they've done to try to make it all fair to both sides, the exiting guy and the guy staying, right? So that's kind of what's happened. I don't dispute the fact that we all need to be concerned about the quality of the receivables, right? The loans, are they gonna pay off? If they don't pay off, the problem gets deeper. But so far, it's been pretty good. So far, it's working. And on fees, I heard something on fees. There's a lot of noise about fees. Well, the fees have come down over the last couple of years, across these products. And they're disclosed, easy to understand, we think, and pretty straightforward, way less complicated than they used to be. And I'm speaking as a guy who's been at this for 43 years, looking at these programs. So we see a lot of stuff, and it's all been improved. And the last thing I'll finish with is we continue to evolve in this space. This space is always evolving. The latest evolution is Blackstone did BXDC, Blackstone Data Center REIT, a publicly traded deal, $2 billion, but it looks like a NAV REIT. It's externally advised. They have no assets except the cash that just raised, $2 billion. It's trading at a 10% premium right now on the expectation that Blackstone's going to fill it with data centers that are going to work great. So my point is, they're addressing the liquidity noise, right? They're saying, okay, if you don't like the 5% a quarter, let's do a publicly traded deal and give you liquidity in the publicly traded market and see how you like that, right? Publicly traded REITs right now today trade at generally a discount to NAV, except for data centers and some healthcare, but generally a discount to NAV. Nobody's rushing to do them right now, right? The NAV REITs are holding up because they're in and out at NAV and people kind of like that outcome. But my point is the space continues to evolve to address the concerns everybody is expressed here today. And I'm not dismissing anybody's concern. They're good concerns. I'm concerned about it too. But I think the industry does a pretty good job addressing it. Thank you.
Thanks, Kevin. Joe, one of the things that we've heard some firms say in connection with the current private credit events is that retail investors don't understand these products and that product advertising is contributing to that confusion. In preparing for this panel, we learned that some of our fellow committee members were not aware of the work that is being done by FINRA in your department. So can you tell us a little bit about what your team does and maybe provide a high-level overview of the key FINRA rules that apply in this space? Does FINRA engage with other regulators, the SEC, other state securities regulators on policy issues like this one, or in the day-to-day review? Thanks.
Like my fellow panelists, I'll say thank you to the IAC and the SEC for having us and for having me. For those of you who don't know, FINRA is a self-regulatory organization that focuses on the broker-dealer community in the United States. Our core focus is on investor protection, market integrity, and maintaining vibrant capital markets. Very similar mission to the SEC. We work, to one of your last questions, Amy, closely with the SEC, the states, and other regulators like SIPC and MSRB in regulating the markets touched by the broker-dealer community. In the private market space, FINRA's role, though, is somewhat narrow, especially compared to the overall private market universe. As I mentioned, we're focused on the broker-dealer activity in this space and the associated persons of broker-dealers. We do not oversee the issuers or the other financial intermediaries that operate in this space. And the vast majority of private securities, as most of you probably know, are sold outside of the broker-dealer channel. If you look at Reg D statistics, something like 10% of those, maybe up to 20%, are sold through broker-dealers, depending on if you're talking about retail or institutional customers. So a very small portion of the overall private market space. That said, when they are sold through a broker-dealer operation, we have a lot of interest, and similar to the concerns that were already discussed, we share these concerns and these risks that we look at through our regulatory operations program, like our examinations group, investigations. We have ongoing surveillance and monitoring. But I'm going to talk mostly about the two groups that I oversee, which is corporate financing and advertising regulation. Both of these groups play different functions but are interrelated, and I'll talk about those briefly. Corporate financing is a small team that covers both public filings and private filings sold through broker-dealers. The public program has a place in the alternative world, but when we're talking mostly about the private programs, I think about our 5122 and 5123 rules, which are private offerings either sold by a member or its affiliate, which is 5122, or generally sold to a retail investor, including accredited investors that are not institutions, QIBs, or certain specified parties. 5123 and 5122 require filing with FINRA about information on offerings sold to retail customers, and we review those filings for assorted risks, things like due diligence, marketing, regulation, best interest concerns like reasonableness of the investments, and other issues like contingencies. We do that on the front end in my program, and then there are, as Commissioner Ueda referenced, there are sales practice risks that are evaluated through other programs like the examination program that looks at point of sale risk. One of the key points about 5122 and 5123 is that it requires the filing of retail communications associated with the offering to be filed with FINRA, so we have an opportunity for those offerings that are sold through broker-dealers that have a retail component and a communication. We get to see those communications, and those are reviewed by both corporate finance for an initial pass, and then subsequently where there's potential risks by our advertising regulation program. So I'll talk about that team now. The Ad Reg group reviews material that we receive from the CorpFin program relating to private placements. but we also review filings that are made by broker-dealers required by our rule, FINRA Rule 2210, which is our communications with the public rule. We have other communications rules that are pertinent, but 2210 is the most relevant. It's a principle-based rule that requires all member communications be fair and balanced, that they provide a sound basis for evaluating the facts in regard to any particular security, type of security, or industry discussed in the communication. 2210 also prohibits members from omitting any material of fact or qualification if the omission would cause the communication to be misleading. Members also must ensure that their statements are clear and not misleading within the context in which they are made. The documents and the communications really need to stand on their own. I know one of the things we'll talk about now is disclosure sufficient when it comes to marketing? If you're talking about things like liquidity or using terms like semi-liquidity, you can't rely on the fact that the prospectus discloses the risks associated with that liquidity. If you're talking about the benefits in the communication, 2210 requires the statement to be balanced and disclosed and stand on its own within the communication. We've issued notices and FAQs in a number of spaces, but one of the most notable ones is Notice 2021, which provides guidance on retail communications concerning private placements. We highlighted some concerns in that notice around statements that emphasize benefits without discussing risk, false, misleading, or promissory statements such as assertions about the likelihood of future public offerings of an issuer, claims about future success that aren't balanced, impermissible projections of performance or forecasts that do not have a sound basis. And the notice also discusses some metrics that are commonly used within the private security space, like operating forecasts, distribution rates, and internal rate of return. And we highlight some of the considerations that we expect firms to take into account when they're using those communications. As we continue the discussion today, 2210 will probably come up a few different times as I'm speaking. It's a pretty critical role. It's really about whether the communications that representatives and firms make with their customers about private securities are fair, balanced, complete, and can stand on their own. I'll just highlight again that FINRA's role in this space is relatively small to the overall market. The rules that we have apply to broker-dealers and their associated persons, and transactions and activity that's occurring away from broker-dealers are not subject to these same requirements.
Great. Thank you, Joe. And thank you to all the panelists for getting us started with a great overview of the issues. At this point, we will shift into more open Q&A format while I will pose questions on specific issues that any panelist can respond to. Stephen, I will try to keep track of you on the screen, but please speak up if I miss you, and the same for Andrea, who's also online. As mentioned at the outset, the goal of this panel discussion is to explore strategies that regulators and the industry can use to reduce investor confusion regarding private market assets. And as we've heard, a common source of investor confusion is private market product advertising. Our first set of questions will focus on various private market advertising practices. We'll start with the use of the label semi-liquid. We've seen some industry leaders recently criticize use of this label in product marketing because it might lead to unrealistic expectations for smaller retail investors. In the private credit context, a firm representative came out last month and said directly that private credit is not semi-liquid. He stated emphatically that those products are really illiquid, and that the label has given retail investors the perception of more liquidity than is the reality. Now we've seen other industry leaders push back in support of the label, saying limits on redemptions have been properly disclosed, often on the first page of the prospectus. What do you all think? Is the semi-liquid label a problem? Is prospectus disclosure an effective strategy to counteract the perception created by the advertising label? Do you think retail investors are even reading prospectus disclosures?
I'll tackle that. Yeah, the answer is they're reading them, they're aware of them, and we're not hearing a lot of screaming and yelling about people that got capped. You know, they know that that's what's coming. Their FAs know that that's what's coming. So, and it's big. They're gigantic numbers in terms of the amount of redemption activity that gets honored in this space. So I think that it's overkill. Not to say you can't make it better. Witness Blackstone doing BXCD with a traded security, right? They're same REIT you would otherwise see. They did it with a traded security as the exit. So we're going to see more of that. But I think to have $80 billion of capital get redeemed on about $400 billion of original raise is a phenomenal outcome that only came about because we had big players prepare for it. They got ready for it. Not to say there won't be more deals that get stuck in the mud, but for now, it's operating absolutely as expected. And big players, and that Blackstone announced this morning, they got 10% redemption requests. They met 5, they hit the cap, right? So that's good. We should be applauding them. We at Stanger gave all those guys, with one exception, gave them all gold medals, which for what they've redeemed over the last couple of years. So we think that semi-liquid is not a misnomer. Should investors be educated? 100%. Investors should be better educated, but I think it's not a misnomer to say it's semi-liquid.
Go ahead, Mark.
I disagree with that. I think that the semi-liquid label, if you understand the drivers of liquidity, it's the underlying liquidity of the assets, the desired liquidity of every individual, and then when you get a loss of confidence in the asset class, which will eventually happen, historically it does, then it's the perception of what every other investor is going to do. And I think that is missing from the term semi-liquid. I don't think it requires that much explanation in terms of a disclosure, but again, that's for the SEC to decide. But what ultimately is missing is that historically, and in this case, and I don't look at this as an innovation, I look at it as a repetition. The label's problematic because the products are structured in a way that liquidity is most likely to be limited precisely when investors desire it. I think that's what you're seeing right now, and I fear that doesn't come through in the label.
Thanks, Mark. Joe, did you have something to add?
Yeah, I would just, my personal point of view is labels create some of their own challenges when you use shorthand, and a lot of this is the devils are in the details. And to the points made by both Kevin and Mark is people have to understand what it is they're getting themselves into. The marketing has to align with the actual nature of the product. So using a term like semi-liquid without a real understanding of what the limitations or aspects of that liquidation feature is or is not is critically important, especially in the marketing materials. So when we see terms like semi-liquid as a feature that is being touted as a benefit, we expect to see a balancing statement explaining the risks and limitations on that label or terminology. So, using terms without that substance is really something we continue to focus on at FINRA and would expect firms to consider when they're using that shorthand. It's not something that we would expect to see without the proper context for an investor and a representative to understand what the product features are.
Can I follow up on that? This isn't actually written in our question, so hopefully it's not off the map here. But Mark mentioned earlier that, and because he is sort of not in favor of the use of semi-liquid, I thought I would bring it back around. He mentioned the context of when, in particular, gates would be relevant. Joe, when you talk about a balance statement being required, is it some of those defined contextual events that are in that type of communication to alert investors as to when it could become a liquid?
Yeah, absolutely. The provisions that might impede a liquidity opportunity, things that might put that risk in play, like a gate, or the fact that it's limited to 5% or whatever the number is of the overall pool within periods, and the exigencies that might create further limitations to that redemption are things we would expect to see when you're discussing the benefits of a semi-liquid product.
Amy, if I could just add a quick point. I spend an inordinate amount of my day reading research in cognitive psychology, and my big fear here is the same fear I've always had whenever I think about securities regulation, which is that disclosures are designed by regulators who are lawyers, written by people at firms who are lawyers, and they're presented as if everyone else is a lawyer. And for better or worse, and I'm pretty sure it's better, not everybody else is a lawyer. And the typical investor, and more importantly in today's economy, the typical financial advisor may or may not understand the disclosures. And there's also very good evidence from psychological research that the greater the length of disclosures about risk, the more likely people are to conclude that the risks are improbable. If it takes you that long to explain to me why I might lose my money, I infer from that it's not going to happen. I mean, if you tell me I'm going to lose my money if I get hit over the head with a 2x4, I can understand that. But if you take 5,000 words to explain a risk, my natural inference from that explanation is, that's not going to happen. And of course, risks like those might well be the ones that are most likely to happen. But the longer the disclosures get, the less likely it is that financial advisors will understand them, particularly when they have conflicts of their own. For example, if they work for an RIA that just so happens to be owned by a private equity firm, they might not be particularly motivated to highlight the risks of a private equity fund. And we're arguing about terminology and the effectiveness of disclosure that the recipients, I would argue, don't read. I would disagree with Kevin on that point. And it's very far from clear that they understand it. I think the typical financial advisor at a large firm is working off some model portfolio that's designed by the home office, and it's been approved, so they recommend it to their clients. They haven't read the prospectus. Somebody else read it and told them it was okay. And I see Sheldon nodding. And that's how the economy works. And we talk about the investor as if the investor is the sole decision maker. Nowadays, in current financial markets, it's more likely that the financial advisor is the decision maker and the investor is simply approving it. And if the financial advisor is either ill-informed, uninformed, or conflicted, then the length or the specificity of the disclosure isn't going to matter very much.
Yeah, I think that sort of touched on one of Commissioner Peirce's questions in her opening remarks with regard to additional disclosures. So thanks for that addition there, Jason. I appreciate it. And as a non-lawyer, I appreciate the recognition of the naive investor perspective of reading those risks. Potential naive perspective. Moving on just to a slightly ancillary and related topic, a related marketing claim that comes up often in the discussion of semi-liquid evergreen funds is that redemption gating, the mechanism used to restrict cash leaving the fund, is a product feature, not a bug. Let's dig a little deeper into this debate. Is there anyone on the panel who would like to explain why gating is a feature and not a bug? Maybe Kevin, you want to sort of dive into that one? Can you turn on your mic?
Oh, I'm sorry. It's clear what's going on at the beginning of the deal, right? You got a chance to get out at 5%, and I put my money up. I know I can get out up to 5% of the outstanding, and he puts his money up, and he is going to stay in it. So he wants to know I can't take all my money out, or take all the money can't leave, and leave him standing there as the last guy. So that's important. It's an important feature of the deal, and it's an important thing to understand. And it's no different than a CD penalty if you cash in your CD early, right? You got to wait. You got to wait some time. Historically, this generation has recognized and met all the redemptions up to this latest round with the BDCs, and the BDCs have hit the caps, and but they're not gating in front of the caps. So I say they're meeting what they say they're going to do, and it's a valuable feature that people embrace, that people like, that people are glad they got. The FAs are glad. The retail investors are glad. We don't see litigation about it. I get involved in litigation periodically. I've seen no litigation about it. So I think people accept it, understand it, and they realize that that's a limitation of the program. And I think that's kind of how I size it up. And the size of the redemptions has been gigantic, $80 billion non-traded REITs and BDCs in the last 4 years. It's staggering, really.
I mean, I'm sorry, I disagree with that as well. When you think about the purpose of the gate, what it's designed to do is, I think it's most important when you have a broad and a widespread loss of confidence and everybody redeems at the same time. And I don't know if we're at everybody yet, but we're at a substantial amount. And when that happens, the goal is to use the gate to buy time until the market, confidence returns, or things can be sold for a reasonable price relative to the marks. And these things can last a long time. And we've had gigantic redemptions. They can get bigger. If you've studied run-like events in the past, trust me, they can get bigger and they can last longer, and there can be damage as a result. So I'm not saying you said this. You did say it's working as designed, but we're still very early. I mean, we're 3 months into this. The second quarter's rolling around. We're already seeing redemptions go up. It remains to be seen whether these will work. The analogy I've used is it's kind of like applauding the levees when 5 inches of rain have come down and the storm surge hasn't arrived yet. We'll judge the effectiveness when we see 30 inches and a 15-foot storm surge, and that can happen. So I think it's very premature to say they're working.
Along these same lines, does anyone care to share views on larger market impact when there is serial gating of redemptions by a large sponsor or serial gating by multiple sponsors? Mark, you kind of alluded to that just now. That sort of sparks an investor run, so to speak. Are there potentially systemic implications, or are the private markets too small, or are these features already in place to alleviate that concern?
I don't know if I'm qualified to speak to the potential systemic impact, but one of the things I would highlight is our expectation would be for firms as these types of issues evolve, that their diligence remains ongoing and their marketing evolves. When you have a redemption, limitations, or gating, and your marketing doesn't highlight that, or you continue to sell the product the same way as if there were no gating or redemption issues, those are things that we would have concerns with, and making sure that firms maintain that diligence on an ongoing basis as market events evolve is something that we would expect on an ongoing basis.
Really quickly, I haven't seen any evidence that if the definition of systemic is this a GFC type event, I haven't seen evidence to support that, which is a relief. That's not to say it doesn't exist, but as far as I can tell, I haven't seen it.
Great. Thank you. Let's move away from liquidity now and discuss product volatility. The price swings that accompany market volatility can make some investors very nervous. For that reason, investment firms specifically ask their retail customers about their volatility risk tolerance in the investor profile form. Private market and alternative asset products are frequently marketed and sold as low volatility products. Like the semi-liquid label, not everyone is comfortable with that classification for these products, and some have argued that it's confusing and misleading to investors. You might have even heard some people use phrases NAV smoothing or even volatility laundering to describe this marketing practice. Can anyone on the panel quickly explain what the critics mean when they say there is NAV smoothing or volatility laundering? Maybe Mark, if you want to tackle that one.
I hadn't prepared that, but I'll give it a shot. I mean, I think the concern is that when you have marked values that are not marked to market, they're based on appraisals, and they're not that frequent, it gives the perception that volatility may be lower than it is. I mean, it's like your house. If you quoted your house every day, it actually varies in price, but you don't see that because there's not a daily price. I mean, I guess Zillow counts, but you know what I mean. So the concern is that if these are being marketed as very low risk because the reported volatility, which could be artificially depressed, is low relative to the return, that's a concern in terms of misperception.
If I could jump in, Amy, I think there's another shorthand way to think about this. A couple of years ago, I wrote a column about this exact topic of the claims of extremely low volatility on the part of funds that hold non-traded assets. And one of the funds I wrote about was quoting a Sharpe ratio in excess of 10, which the snickers are at the table around me indicate some people have advanced degrees in finance. A Sharpe ratio of in excess of 10 is an extraordinary rate of return in excess of the risk taken to achieve it. And so I did what even a rookie reporter would do, which is I called Bill Sharpe, who is the originator of the Sharpe ratio, and I just asked him, what do you think of this? And he said, oh, that's Sammy Sharpe's ratio. And I said, who's Sammy Sharpe? And he said, well, I don't know, but it's not my ratio. And I mean, he strongly disapproves of any alternative fund invoking the Sharpe ratio as a marketing technique, because he justifiably feels that if the assets don't trade, you can't measure their riskiness against any asset that does trade. And he feels that it's inherently misleading to use the Sharpe ratio to describe the volatility of something that artificially has low volatility.
Joe, do you have anything to add to the conversation with regard to, in particular, claims on volatility in advertising for these types of products?
I'm going to sound a bit like a broken record, but where a firm or a rep or an issuer through those entities are making claims, again, we're going to look to understand what is the basis for that claim. Is there a sound, describable basis for why you think or why you view this as low volatility? We talked about Sharpe ratios, which is not my field of expertise. I felt a little singled out, Jason, by the way, as an attorney before, but I didn't mention it. My apologies. It's okay. We're looking for what is the basis for those claims, and again, what are the balancing statements? Is there a structural constraint on the product that is creating a false sense of low volatility? And again, what are the parameters that support that claim is what we would expect to see. Many years ago, FINRA introduced some requirements in our account statements rule that required more current pricing on products that moved away from, that introduced really NAV pricing. And what we would expect is the communications and the marketing reflect what the actual product features are and what the basis is for those claims.
Great, thank you. Let's move on to the endowment model marketing. Jason wrote an interesting article called Yale Invest This Way, Should You? He discussed the risk of endowment investing models for retail investors. Product sponsors and selling firms like to advertise the endowment model as a way for retail investors to generate greater returns by increasing their allocations to alternative investment products. Sometimes you will see the products advertised as institutional quality to reinforce that perception of exclusivity. I don't know any investor who doesn't want to increase their investment returns, me included, but that does not automatically mean that the endowment model is suitable for every retail investor. What should retail investors know when they are being pitched the endowment model and are being asked to increase their allocations to institutional quality investments? Are there certain investors that this model works best for, other than Yale, and others not so much? Jason, do you want to start?
Yeah, sure. Thanks for that question, Amy. I think the single most important thing for everyone to realize and many endowments themselves to accept is that the endowment model hasn't worked for most endowments. If you look at the NACUBO data, if you look at the research that Richard Ennis has done, it's highly dubious that most of the institutions that ended up imitating David Swenson's success at Yale have had comparable success themselves. To succeed in alternative assets, you not only have to have access to top quartile managers, but you have to be able to identify them in advance. And in my experience and based on a lot of the research, that's extraordinarily difficult. I think the other thing about alternative assets that Stephen alluded to earlier is there's a timing question here. The backward-looking returns on alternative assets are extraordinary, but the bulk of those returns were earned over a period of either low or zero interest rates, and levered strategies, which many alternative assets benefit from, are not going to benefit from zero interest rates from here on out unless policy changes drastically. Furthermore, Yale and the earliest endowments were very early. And now that trillions upon trillions of dollars have poured in, and there's a substantial amount of data showing that companies that are taken private by private equity firms are being taken private at major premiums to the prices in public assets, there's a case to be made that you're overpaying if you're investing in these markets today.
Thanks, Jason. Does anyone else have anything they wanted to add? Joe?
Yeah, I would just jump in and say that generally speaking, I think FINRA's view would be that marketing a retail product as institutional quality or institutional equivalent would be misleading. There's often very substantial differences in the terms, the fees, the structure. So without, again, that context that we would expect, on its face, it would probably be misleading unless you could make the clear arguments and define the sound basis for why a particular product is the equivalent of quote-unquote institutional quality or institutional grade offerings.
That's very helpful context. Thanks, Joe. Stephen, did you have anything to add? I'm not sure if you're raising your hand, but I see you moving closer to the camera, so.
Yes, I do. Thanks, Amy. Well, I think that Jason really did a public service with that column that he wrote. I have a concern about retail attitudes to the extent they want to invest in private markets if they think they're going to get Yale-like returns. And the question or the concern is, are they chasing an illusion? Can retail ever duplicate the conditions that institutional investors have enjoyed? That's a separate question to say, well, that's in the past. Institutional investors won't enjoy it in the future. And I wouldn't dare predict the outcome of that. But even if private equity bounces back and institutional investors do well, I think that doesn't mean that retail will. And the differences are stark. Let me just focus on one, and that's incentives. In a traditional fund, say a traditional private equity fund, the key incentive is the carried interest, 20% of profits above a certain threshold. The deal team, though, has to do an awful lot to earn that 20%. And this was brought up in the SEC roundtable on valuations a few weeks ago, because the private equity team does not just buy a company stock and hope it goes up. They buy the company. They have to have a plan. They go in, they own it, they change the company, they improve it, they create their own alpha, and then they sell it for a profit. If all that works, if it works, then they earn an awful lot of money. But it has to be on the realized returns, not the unrealized returns. And I think that the retail-facing private funds, especially they build out more, often have a different model. It's based on fees on assets under management, AUM. It's not based on the eventual success in changing a company and selling it for a profit. How is that going to change behavior? And here I am talking with Jason as the expert with thinking slow, thinking fast, but I will say this anyway. I ask, what will the incentive be? Will the deal team be thinking not how am I going to improve this company, but Can I do more and more deals? Can I keep constantly striving to increase assets under management? And if those are the incentives, is that going to change the competitive advantage? And related to that, are we going to end up with a two-tiered system? You let retail investors in, but you've got two classes. You have traditional style private funds that are institutional with an institutional investor base, just like before, and they're going to make great returns, maybe in the future. But separately, you're going to have retail-facing funds with a fee-based structure, more reliable, less risk for the fund sponsor. But are you going to have very modest returns? And is that going to disappoint the expectations of retail? Well, I'm not going to predict the answer to that. I don't think anyone knows, but it certainly is a concern of mine.
Thanks, Stephen. I'm going to move us to concentration risk, which is somewhat related. FINRA recently issued an investor education piece on this topic, actually a few years back. The alert warned retail investors about excessive concentration in illiquid investments using private placements and unlisted direct participation programs like non-traded REITs as examples of products that can be difficult to sell quickly. Does anyone have advice for retail investors who are monitoring their concentration of private market assets? What can they do to better manage their risk? Joe, do you have any thoughts on that one?
Sure, I'll start it off, and I think it goes back to some of the things that Jason and Mark were mentioning, investor education and investors really understanding the products that they're investing in and what portion of their portfolio can withstand the potential loss of capital associated with those investments, but also the limitations on accessing that capital. We don't have in FINRA any specific set percentage in which a customer is limited investing in certain products or sectors, and that's really a decision that we think is appropriate for individuals to make for themselves and to do so with their financial advisors, but them understanding what it is they can afford to not have access to, that they couldn't liquidate if they needed to, and really understanding those products along with their advisors is the point I would emphasize.
I want to try to, I'm cognizant of our time, so we have probably 5 more minutes, and then I'll open it up to the IAC members. But this next one, I think, is one that could be actionable for the IAC to discuss further. Some states impose limits on the amount of a non-accredited investor can invest in the unlisted REITs and BDCs, basically no more than 10% of their liquid net worth. This has helped their investors avoid having too much of their capital tied up during recent redemption gates. The SEC just issued a preemptive rule proposal that, if adopted, would eliminate those state limits moving forward. Regulators could still regulate allocations at that point by enforcing conduct standards on the selling firms. What should the SEC and other regulators advance as appropriate allocations under those standards? Does anyone have any thoughts on that? Maybe too technical? Okay, well, you can get back to us if you have any thoughts on that one. Okay, so now the one that I'm super excited about, valuation. Much of the retail growth in the private market or alt space in recent years has been with evergreen, sometimes referred to as perpetual life, net asset value products. Not surprisingly, the NAV is very important for NAV products. Investors use NAV to comparison shop within asset classes, and NAV impacts the fees investors pay to the manager. NAV is a non-GAAP figure, which tends to invite heightened regulatory scrutiny. Is there a best practice for calculating NAV, net of fees, net of leverage? What financial metrics should investors be paying special attention to when assessing NAV for private market assets? Any thoughts? Mark.
Well, this isn't going to totally answer the question, but it's the thing that I think is most worthy of attention is and I mentioned it earlier in the first question, is the use of what's called the practical expedient under FASB's guidance called ASC 820. And what it allows funds doing that are purchasing positions on the secondary market, mostly in private equity, is they usually get it at a discount. It can be 20, 30% discount. And after they buy it, they literally mark it up to the last reported NAV, and going forward, the reported NAV from the general partner. And what that does is it creates a one-day gain. And what that, I believe it plays a pretty important role in enabling funds to generate very attractive returns early on, attract more capital, buy more, mark them up, and you can see how that could be problematic. And I do think that very few people are aware of the relative impact that this has on the reported performance of this fund. And that is something that I think is worthy of attention in terms of making sure that people are not confused.
Yeah, and I'd like to add a note to what Mark just said. My great colleague at the Wall Street Journal, Jonathan Weil, wrote a remarkable article, it was maybe a year and a half ago or so, on exactly this topic, the one-day gains that were being reported by secondary funds. And I think it's important for people to realize just what these one-day gains look like. I think if a fund is reporting a 1,000% daily gain from a non-publicly traded security, anyone who invests in that fund should be suspicious of the quality of the fund's reporting. And we have historical precedent for this. In the late 1960s, mutual funds, just regular open-end mutual funds, were buying what was called letter stock, and they bought it hand over fist. And I think by some estimates, if you took the combined assets of those funds and adjusted them for inflation, that marketplace in the mutual fund industry was something on the order of $40 or $50 billion in today's money. And there was even, the funds were so open about it, there was even one whose name was the Fund of Letters. And what a letter stock was non-traded, it was a non-traded class of common stock issued by a publicly traded company, and it went onto the fund's books at a sizable discount, often 80% or more, and the fund manager would then mark it up near or at the value of the publicly traded common stock. And this game went on for quite some time until a guy named Fred Mates put way too much of his fund's money in a thing called Omega Equities. And I have it in my notes here. He bought it at $3.25. He marked it up to $16 immediately. And then the SEC took action against Omega as a fraud. And then he marked it back down to $3.25. And I believe it eventually went to zero. And the SEC cracked down in 1969 and 1970 on this practice. And among the terminology in one of the SEC releases was that this practice, quote, creates the appearance, close quote, of appreciation, open quote, which has not in fact occurred, and accordingly is improper, close quote. And I think it's an interesting question as to whether that same approach is suitable when we think about practices like what's going on currently in secondary funds.
We look at a lot of securities, and a lot of companies in this space have seen that once or twice, but it's not a regular occurrence. And so I don't think it's a big deal. But I agree with you. We would reject it and say that is inappropriate. Don't allow it. Don't do it. Don't recognize it. So we agree with that notion, but I don't think it's particularly happening here, mainly because there's not a lot of equity trading in the secondary market because the liquidity feature is seemingly working for the most part, right? So people aren't willing to sell at a 30% discount when they can wait another quarter and get their money out at NAV, right? That's kind of what is going on now. Not to say we shouldn't be alert to it and looking for it, but I don't think it's pervasive today.
I do want to correct the record on that. It is very pervasive in the funds that I've seen. That in private equity, I mean, maybe not private credit, but in private equity, it is very common and very significant with funds that have launched recently. It can constitute near 100% of the gains in a couple cases that I've seen.
Pivoting, but still on the same valuation topic, what about the underlying
Amy?
assets? Oh, sorry, go ahead.
Stephen Dean, I think, would like to weigh in.
Thanks, Andrea. Stephen, go
Yeah,
ahead.
thank you. A couple of comments. First of all, with this NAV squeezing, that's what I was trying to get at earlier when I was saying that with a traditional drawdown private equity fund, it's based on realized returns. So if you're going to mark it up with the way that you're talking with a NAV, a new estimate that exceeds your purchase price, you haven't sold it yet. That's unrealized, and that's the distinction I was trying to make. A couple of quick things. One is, Amy, you asked about whether the disclosure should be net of leverage. We have a GIPS standard, which I think stands for Global Investment Performance Standards, and if my memory is right, we do say it should be net of leverage. But the main thing that I wanted to say is this. On the one hand, I think that things like NAV squeezing specific things might be problematic and we need to look at. But I also wanted to step back and actually say something nice about private markets, because a lot of our comments have been critical to try to balance out a little. It does not address specifics like NAV squeezing, but it does address basic valuation issues. It's easy to see what the challenges are with price determination in private markets. Things don't trade, they're illiquid, you can't mark to market, you need models, so it's going to be subjective. But there's also an argument that actually there are advantages in the valuation of private markets, and that's the main point I want to make. And the argument is that companies today are asset light. They don't have asset heavy balance sheets like GM, like companies in the past. They have IP, intellectual property. They need confidentiality. Their intrinsic value is based on future expectations, not on assets they have. So in that context, there's an argument that actually it's hard for them to tell their story in public markets, that private markets, which are more confidential, are actually a better place where they can tell their story and get investors who can get a better sense of what the intrinsic value is. And if you accept that argument, it would explain one reason why companies are staying private so much longer. Now, we've deregulated, so now they have the option. They didn't have the option before. But that deregulation doesn't explain why they choose to stay private. And I think it's a persuasive argument in my mind now that maybe there are some advantages to valuation in private markets. None of that negates what's already been said here about the concerns about NAV squeezing and some other more specific practices, but I did want to get in something that's more favorable to private markets on the valuation. Thank you.
Thanks, Stephen. I appreciate you offering some balance to our panel. I just want to stick on this one more question, and then in the meantime, if any of the IAC members have questions, please feel free to put your tents on the side, and I will call on you in order the best I can. The underlying assets in these NAV products are supposed to be independently appraised, but the appraisals are just inputs in the valuation process. Managers generally have discretion to set the NAV at the value they believe is fair. So we've talked a little bit about people marking them up if they buy them on the secondary market. Is there any way for an investor in these funds to know when a manager overrides the third-party input to set NAV at a value that maintains or boosts the manager's compensation? So not so much where they're buying it on the secondary and marking it to the current market value, but the actual market value NAV. If valuation is an issue that investors should be concerned about, what are some red flags that investors should be on the lookout for? Does anyone have any thoughts on those topics?
Well, I mean, this gets at one of the problems we've been talking about all morning, which is that the quality of disclosures doesn't always address the underlying incentives in a very transparent way. I believe in 40 Act funds, it's customary to disclose on the fee table in the prospectus the acquired fund fees and expenses in a pretty forthright way. we could get into a situation where if alternative assets are held in a collective investment trust, for example, within a 401k, I don't believe CITs are subject to that rule. And there are lots of other ways that, the sponsors of funds could make end runs around that. So I think it would require an almost complete rethink of the disclosure regime if we're going to make access to alternative funds universally available to the investing public as a whole. We can't take the existing disclosure regime and tweak it. We have to say what's the right way to disclose unfamiliar and, for most investors, unprecedented types of risks from scratch. And that's not the way the regulatory process usually works. It's usually incremental and additive. And I would argue in this case, it needs to start from zero, because if you're introducing a radical change in the availability of products, you should also change the disclosures in a radically transparent way. And I wish we see that, I hope we see that, and I doubt we will see that.
Great, thank you. There are a number of tents up in the room. I'm really grateful for the active engagement of the IAC members. I'm going to start, I don't know that I got them all in order, so I apologize if you're out of order based on this list, but Adriana, will you go first, please, with your question? Thank you.
Thanks, Amy, and thank you very much to the panel for very informative discussion. I guess my main question is, there's been a lot of discussion about confusion and about what investors think they're getting and about what people think semi-liquid means, or whether people are, surprised when they hit caps and hit gates. And I guess it would be really helpful as a representative of investors to know whether there's any evidence about what investors actually think they're getting and what they think these terms mean and what they think these disclosures are telling them. Because part of the challenge, and that's also what I guess Commissioner Peirce mentioned this morning, we put all sorts of stuff in the disclosures, but then we don't have a good sense of whether people understand what's there. On the other hand, they do have advisors of various kinds who maybe are explaining things to them. So I guess, do you know, does anybody know whether people are surprised? I mean, people are disappointed when things don't go the way they would have liked them to have gone, but that's not the same thing as not understanding on the front end what was going on.
Well, if I could jump in there, thanks, Adriana. I don't know. I confess maybe others do, but I want to make a point because I suspect I'm not the only one who doesn't really know. In my view, this cries out for investor testing. It'd be really interesting to ask investors in, say, BDCs or private credit funds, did you understand the illiquidity? Did you understand the gating? Was it properly explained to you? If not, why not? It'd be great to, if possible, to do some investor testing on investment advisors and broker-dealer reps. I don't know if that's possible. There's a great deal of SEC experience in investor testing. The office I used to work in, the Office of the Investor Advocate, built up when I was there an investor testing capability. We always said we wanted to even develop a rapid response investor testing capability. If there's ever a time where we could deploy that rapid response, this is it. I would love to see some investor testing. The Office of the Investor Education and Advocacy did investor testing and spearheaded a 2012 National Financial Literacy Study. DERA has done the capabilities to do investor testing. Outside the commission, the FINRA Education Foundation routinely does financial capability studies. So my response, Adriana, is I don't have a direct answer, but I'd love to see some real investor testing that could answer your question.
Yeah, I mean, I would just add that there's plenty of past research on what investors understand, which is not very much. But I'm unaware of anything that isn't industry-sponsored that looks at the question of what investors understand about alternative assets. And I agree, there's a crying need for it.
Great. Next up is John and then George.
Oops.
Okay. Well, first of all, I want to say that Adriana's question and the answer resonated deeply with me based on my professional background, which we can talk about later. But first of all, as my first chance speaking at this committee, I want to say that I'm very honored to be a member of this committee, very grateful to have the opportunity to sit and listen to such incredible expertise. I guess the question I want to pose to Jason, and by the way, Jason, your brilliance in understanding and characterizing the retail investor, especially non-lawyer retail investors, is just, I heard myself in your description.
You need to get out more.
Let me get to my question. So I guess I'll give this question to Jason, Mark, or Stephen, any one of you. Directionally, because I'm sure there's no simple answer to this question, what are the three of you really thinking? Are you suggesting that, someone waves the proverbial magic wand and we roll back and not provide retail investors private market access? Or, Jason, one of your last points of completely rethinking how disclosures work? Is there a relatively short answer to that? What is the directional?
I guess I should go first. No, I'm not. I'm certainly not suggesting that no individual investor should ever have access to alternative assets. I certainly don't believe that. And even if I did, it would be that would be a bridge way too far. To mix metaphors, I think the train has already left the station. But I think everyone in the regulatory and financial market ecosystem needs to recognize that we're not talking about a gradual change in the portfolio of the American household. We're talking about a drastic change. We're talking about the biggest change since probably the 1920s. We're inviting people to invest in types of markets that in the aggregate they have not had access to in their lifetimes. And if we're expecting them to do that using the disclosure and other regulatory tools that were designed for a different marketplace and expecting that the outcome is going to be beautiful for everybody, we're kidding ourselves. It's not going to happen.
I don't have too much to add to Jason. I think we're on a lot of things, we're on the same page. In terms of just some practical things, I agree with the concern that when you have a 100-page document outlining all the risks, that you might as well have nothing, because a lot of people aren't going to read it. I feel, and I'm glad that, and I'm honored to be involved to this panel. I wish the risk could be filtered down to the fundamentals. And to me, the fundamentals are that liquidity is unlikely to be available when most people want it, structurally, and that because of the mechanics of this structure. Two, there may be a potential material distortion of returns because of it. Now, this may not affect every fund, but with the private equity funds, with infrastructure funds, we're seeing it. They could be material distorted, and at least disclose what that is. And then the third thing, I don't know if you mentioned this, but I feel like I need to get it in, is whenever you learn historically, I joke with my wife, I feel like I'm 235 years old, and she gets mad at me whenever I say it, but you've seen enough of these events that whenever you see everybody running in the same direction, your alarm bells go up. And I don't know if that's disclosed, but it seems like asset flows going in are being used as an indicator of approval rather than alarm. And I wish people would be more aware of that.
Thank you. Andrea, I think I cut you off. So Andrea, then George.
No problem. I just wanted to say, I heard a couple of times during the course of the conversation that, where are the complaints? What do investors think? Are they surprised? And as a regulator, I just want to share, we get the investor complaints when there are lockups. And retirees can't access their cash to pay for nursing homes and daily care, and experience, real hardship, and say that, when this product was sold to them, they were talking about them being, enhanced liquidity, that the products have changed. They now provide enhanced liquidity. You can get in and out of them. We haven't had any gating for years. And so that they go in thinking that they can get in and out. And so when there is proration or redemption gating, they are in fact surprised. And so, Joe, I know FINRA publishes data. They do ranking of products that generate arbitration complaints. And some of these products, REITs and BDCs, top the naughty list, if you will, the top 15 security product types that generate customer arbitration complaints. And so SEC could look at its own complaint file, could look at FINRA's arbitration case file, and look at those complaints and see if investor surprise is there. In addition to investor testing, I love Stephen's suggestion on that front.
Great input. Thanks, Andrea. George, did you have a question? Sorry.
Yes, just very briefly, mostly for Jason, but anybody else, obviously welcome to weigh in. So as someone who spent almost 6 years drafting disclosure, among other things, I'm very sympathetic to the fact that disclosure is long and sometimes opaque or difficult to understand, complicated certainly, just because the financial markets are complicated and firms today are very complicated. But I just wonder whether there are solutions to this problem, which is very much a real problem in terms of how much of disclosure does the average retail investor, if there's such a thing, understand. And maybe the solution is not to throw away disclosure or to pare it down, but perhaps to rely on technology. So we can have large language models that can actually customize and translate disclosure, really translate in literal terms based on how much you want to read in terms of length, what's your education level, what's your risk preference, what's your liquidity preference, right? And so take the disclosure, take the 100 pages and distill it according to your own preferences and investor profile. And if you only want to read one paragraph, that's possible today. So is that a potential solution to the problems that you are identifying?
Yeah, you're reminding me of some papers that Henry Hugh has written in the past where he kind of argues for a different informational approach to disclosure. I think it's an interesting idea. I think we have to acknowledge the reality that the disclosure is a legal document. It's essentially, to use the impolite term, it's a CYA document, and it's really written to protect the firm against litigation, not to protect the investor against loss. And it's directed at the investor, but it's really the financial advisor who needs to understand it. And I think it's very difficult for regulators, and it's impossible for the general investing public to have much visibility into how well any given financial advisor understands a complicated, novel product until it's too late. And, I wish there were a way to include in a prospectus language like, if your financial advisor uses the words bond equivalent to describe this fund, get a new financial advisor. The words bond equivalent, in my mind, I immediately translate them to potential 90% loss. And most people don't know that. And I don't know how you make disclosures do that kind of work. I have a lot of sympathy for regulators. The job is not easy. It's not easy.
Great, thanks. Next I have Patrick, then Sheldon, then Alvin.
Thanks. I too am a first timer, and I'm delighted to be here. Fascinating discussion. I'm going to make a comment about disclosure, and then I'll ask a question. My comment may lead to responses. On the subject of disclosure, I agree violently with you. There's much too much disclosure as it is. Jason, you focused on risk factors. I think if Chairman Atkins were here, he would agree with you because he said, we've got to pare back risk factors. No one reads them. They're too long. And it's not only risk factors. It's the entire disclosure document that's too long. And so I know there's SEC action in the works to try to address this, soliciting comments about how to make documents shorter, more pointed, better disclosure documents. And I hope this committee will address that. I will say that I think this is a problem largely created by the SEC over time by adding a disclosure about this and a disclosure about that and a disclosure about this other thing. And then, as Commissioner Uyeda said, a summary of all of the above, and then a summary of the summary. Okay. And eventually, no one reads it, not even securities lawyers like myself or investors like myself. We don't read the whole thing. So there needs to be change there. I also think that, George, while Gen AI may solve things in the long run, in the short run, it's only going to make them worse because lawyers use Gen AI to create disclosure documents. And so they borrow from this prospectus over there and this private offering over there. And yes, it does become more systematic, but it also becomes longer, I assure you. So in the short run, I see it only getting worse. I will add one other thing, which is I'm really driven by your comments, Jason, about the conflicts of interest in all these products. And remember, that too is a disclosure. It should be disclosure number 1 or disclosure number 2 in the risk factors. If your salesman works for a company that's owned by a PE fund, that's a conflict of interest, and you can point out the others as well. So that's my comment. Perhaps I'll pause there and ask if there's anything in reply. I do have a question as well.
Just one quick thing.
Yes.
What you're pointing out and what's been pointed out a lot here about balancing the efficiency of disclosure and relevance of disclosure with the length, that goes back all the way to 1933. This is a debate they had, and it's something that they feared. And it's interesting that it seems like we are at that moment. I meant to bring that quote with me, but I'll send it to you after if you want it.
No, you're right. I mean, the theory was that sunshine was the best, disinfectant, right? And so we're going to require disclosure rather than have merit regulation. Maybe that was wrong, but that's the regime that we have, and it's going on 100 years old at this point. So here's my question for you, and this is, I think, mainly for Mark and Kevin, but it relates to the correlation between risk and return. Let's take semi-liquid funds, for example. Suppose I say, okay, it's really not liquid at all. This is an illiquid fund. Still, there's got to be some return that I would accept in order to make an investment in that fund. I actually like illiquidity because I expect to get an illiquidity premium on my investment for a portion of my portfolio, I should say. A portion, that's another whole discussion, how much is right. But what do you think is an appropriate expectation of a premium for the risks associated with these products? Assuming that you should be in them at all, how much should you expect to earn in order to take the various risks we've been discussing? You mentioned dividends, Kevin, but there's a total return as well. what total return should I expect to be in these funds?
I mean, I guess I'll take both.
I can say you're wrong.
This reminds me of the R-star conversation that the Fed always has. It's like you can't measure it. But the way I look at these funds is historically, if you're very good at this, you have gotten, to Jason's point, you have gotten a premium. But when you look at these things over multiple decades, you start to see long wave cycles. And so I would weigh that against, we've seen a multi-decade increase in capital. There's a lot of evidence that they're overcapitalized. There are large fees associated with these, not only the fund, but the underlying funds. There's the illiquidity, which is probably going to materialize, is most likely to materialize when you most likely want it. There's opacity on valuation. There's potential inflation of returns. To me, there are material fees, there are material risks, and there's a lot of evidence that not only did the illiquidity premium potentially disappear, it might be negative. And if people can weigh those risks against historically the returns that have been generated, that's how I would base the decision. I wouldn't try to measure an illiquidity premium because that can be high, that can be low depending on the environment. To me, the environment suggests it's low if it exists at all.
Okay, so
If I could jump in also with a couple of comments. One is historically, institutional investors have asked for what's called a hurdle rate of 8% a year. So the fund manager does not get its 20%, doesn't get a dime until the institutional investors get their money back that they've invested plus 8% a year. So in that case, that was their answer to your question. They want 8% a year. But I think there's no way we can answer that as a blanket statement. It's just, it depends on the individual investor and what he or she wants. I think that's just their decision. The other thing I wanted to say earlier is that when you mentioned the 33 and 34 Act and we went a different way, we emphasized disclosures. That's true. And when I was at the SEC, we always said we are not a merit regulator because that was the alternative. That was the state regulation, blue sky laws. And the SEC, the Congress decided we're not going to have merit regulation. We're not going to decide for investors what's good investment or bad. Let them decide for themselves. But the other half of that is that there's a strict regime. There's a 10K, there's a 10Q, there's 8Ks, there's public disclosures. And the problem that we're struggling with now, in my opinion, is that we've got 75 or more years of jurisprudence, plus the 33, 34, and 40 Acts that provide the disclosure background to enable investors to make their own decisions. If now we're saying we need to let investors, retail investors, make their own decisions with respect to private assets, that's great, but they're not subject to the 33 or 34 Act. They're not subject to those public disclosures, and that's the challenge. That's what I thought Jason was saying earlier. We're basically starting from scratch. How do you protect retail investors when you've just you've allowed them into the one thing that is not covered by the entire public disclosure regime? That's why we're struggling over this.
Exactly.
So I'll leave it at that.
Okay, well, we are out of time. However, we have two remaining questions, Sheldon and Alvin. So I would ask that you ask your question briefly, and then we have like 1 minute each or so to wrap up. I've been given a bit of grace by George, so please, Sheldon, please proceed.
Thank you. It's an honor to be here also. Just a brief observation. I've been in this industry 30 years. Earlier, Jason mentioned financial experts not being, or financial advisors not being experts on these products. In my experience, I think that's a gross understatement. I have seen this firsthand. Many so-called top producers at various firms have no idea what they're selling to the public. Sorry. I had a conversation with the president of a large firm last summer, private client group president of a big firm, pointing out some red flags I observed back in July, and regulatory lawyers at the firm suggested I speak to him. And his response was something like, well, I know you're right, but there's the demand. Back to your comment about investors clamoring. Thank you.
All right, so I think about popular education to union members and people who are speaking Spanish as their first language, for example. And what I've been surprised not to hear at all in this discussion is a discussion about what does popular education look like if you're going to open retail access up to a huge kind of new population, right? So we've talked about disclosure and the disclosure regime, but I'm looking at investor.gov right now. I'm curious as to if the SEC is going to do, like, put out resources like that, right? Investor advocate, popular education. What could be done? And Jason, I want to hear from you about, like, there's two things that neuroscience teaches us about what it goes into popular education. And then for those who are investment managers or in other parts of the industry, what does telling the average Joe on the street, the average Jose, the average Juana, at least my mom's name, right? Like, what do we have as kind of level setting for the public?
Well, you know how to ask a hard question, Alvin.
That's what my students say.
Yeah, you've put your finger on an entirely, like a whole other level of difficulty to these public policy proposals. I mean, we're not just marketing to people who've never owned private assets before, we're marketing to people who've never invested before. And to people who may be entirely unfamiliar with the disclosure regime and might not even be familiar with the, equity and bond markets, but just so happen to have enough assets to qualify. And there's millions of people like that in this country. And we don't know how to do it safely, and I share your concern. I think rushing into this is a public policy question mark.
I agree, that's a very difficult question. And I would be lying if I said I even am close to the answer, given that it's been a struggle for almost 100 years. But I do think that if you can simplify things, at a fundamental level, on a first principles level, I don't think the risks are that hard to understand with these funds. There are misconceptions about liquidity and when it will be available. There are misconceptions about valuation and how that impacts returns. And there's a general misconception repeats so many times throughout history. It's one of the most repetitive features is when everyone's running in the same direction, your alarm bell should go off. Those are the three risks. So I don't know how to better communicate that, but that is the irony. And maybe it gets to Jason's point that the documents have become CYA. I actually don't think the fundamental risks are that hard to understand if they're simplified.
So if I could just jump in very quickly, I think there's a lot of things that I'd like to say, but given how we're short on time, one thing I'll say, I've always thought that the Investor Advisory Committee, one of its great strengths was to shine a spotlight on issues that it deems as important, and it informs the public debate, it educates people, and I'll admit I'm biased in what I'm about to say, but I think you're doing that right now with this panel, so kudos to you. I'll stop there.
Great. I think that's a perfect place to end on. So thank you for that. Again, thank you to our esteemed panelists for your participation. It's been really, really informative and educational. So really grateful. George.
Thank you to the panelists for this illuminating panel, and thank you, Amy and Andrea, for organizing the panel and moderating it. We learned a lot of food for thought, a lot of food for potential future recommendations and future panels, so really appreciate it. Thank you for being here. So we'll now adjourn for an executive session, and we'll reconvene at 1:45.